The gold oil puzzle: debasement, suppression, or monetary repricing. Flint West reporting. Section 1. Thesis. For most people, gold is just another commodity, a shiny rock, something your grandmother wore around her neck. Oil, meanwhile, is the stuff that powers civilization. It fuels ships, trucks, factories, airplanes, and entire economies. So when gold suddenly starts buying dramatically more oil than it used to, something important is happening beneath the surface. The question is simple. Are we witnessing a normal market fluctuation? Or are we watching gold quietly expose decades of monetary debasement that the financial system would rather keep hidden? Section 2. Grounding, the historical baseline. For most of modern history, 1 ounce of gold bought roughly 15 to 20 barrels of crude oil. Call it the equilibrium zone. Not a law, not a peg, just a range that appeared repeatedly across different eras. Translated another way, a barrel of oil typically cost around 1.5 to 2.5 grams of gold. Then things started getting weird. As of June 2026, 1 ounce of gold buys roughly 49 barrels of oil. Gold sits around $4,210 to $4,222 per ounce. WTI crude trades around $84 to $86 per barrel. That puts the ratio roughly 2.5 to 3 times above its long-term norm. We've seen spikes before. The pandemic pushed the ratio into the stratosphere as the world economy slammed into a wall and oil futures briefly traded below zero. Early 2026 produced another extreme as gold surged toward $5,600 per ounce. But the period from 2024 through 2026 feels different. Gold spent nearly 2 years climbing relentlessly while oil remained comparatively subdued. One asset was screaming, the other barely noticed. Section 3. The debasement dynamic. Now let's talk about money. In 1971, Nixon closed the gold window. The last official link between the dollar and gold was severed. Since then, U.S. M2 money supply has expanded roughly 2,800%. That's not a typo, 2,800%. Meanwhile, gold has compounded at roughly 7 to 9% annually over the same period. Not perfectly, not smoothly, but broadly enough that many investors view gold as a long-term hedge against monetary dilution. Oil didn't do that. Oil had to contend with technology, efficiency gains, new discoveries, fracking, cartels, demand destruction, geopolitics, the list goes on. So here's where the puzzle emerges. If dollars are being created continuously, and gold reflects that debasement, while oil remains tethered to real-world production and consumption, then why doesn't the gold-oil ratio show a clean, persistent upward climb? Why doesn't the chart resemble a slow-motion staircase? Instead, it behaves like a drunken sailor, huge spikes, sharp reversals, decades of sideways movement. That inconsistency is what started this entire investigation. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. The suppression hypothesis. One possible explanation is uncomfortable: paper gold. For decades, financial markets allowed investors to trade claims on gold without necessarily owning physical gold. Unallocated gold, futures contracts, leasing arrangements, synthetic exposure. At various points, estimates suggested paper claims exceeded available physical metal by ratios of 9 to 1 or more. Think about that for a second. 9 claims, 1 asset. That doesn't automatically prove manipulation, but it does create a mechanism through which price discovery can become distorted. Then came 2021. Basel III reforms began forcing banks to fund gold positions more conservatively. At the same time, something strange started happening. COMEX open interest weakened. Physical demand strengthened. Central banks accelerated purchases. China kept accumulating. And for the first time in modern history, gold surpassed U.S. Treasuries as the world's largest reserve asset allocation. 27% versus 22%. The paper world was shrinking. The physical world was growing. Whether that proves suppression is another debate entirely. But it unquestionably suggests that the structure of the market is changing. Section 5. Real-world stakes. Now let's assume gold is being repriced, not because of speculation, not because of fear, but because the market is gradually rediscovering gold's monetary role. What happens next? The implications are enormous. A substantially higher gold price implies a substantially weaker dollar. Imported goods become more expensive. Inflation becomes harder to contain. Debt servicing becomes more painful. And a nation carrying more than $39 trillion in obligations suddenly discovers that mathematics is less forgiving than political speeches. The famous American privilege, the ability to borrow endlessly in its own currency, begins to face constraints. At the same time, countries such as China have spent years accumulating physical gold while reducing dependence on dollar-denominated assets. That wasn't an accident. It was preparation. Preparation for exactly this kind of environment. Meanwhile, stablecoin initiatives and digital dollar strategies may strengthen the dollar's role as a medium of exchange. But there is a difference between facilitating transactions and preserving wealth. One solves payment friction, the other solves trust, and trust is harder to manufacture. Section 6. Contextual clarity. Let's be careful. This discussion is not proof of a grand conspiracy. Spoofing and manipulation have occurred. Banks have been fined. That much is documented. But proving a coordinated, decades-long suppression campaign is a much higher evidentiary hurdle. The evidence remains debated. What we can say is this. The current gold-oil ratio sits at levels that demand attention. Central banks are behaving differently. Reserve preferences are changing. Physical gold continues moving from west to east. And the monetary assumptions that govern the last several decades are being tested in real time. Gold is doing more than rising. It is reclaiming its historical role as a measuring stick. And when the measuring stick starts moving differently than the system that created it, wise observers pay attention. Because sometimes the most important signal isn't the thing being measured, it's the ruler itself. The gold-oil ratio may not tell us exactly how this story ends, but it is telling us that something fundamental is no longer aligned. And when reality finally forces that alignment to return, the consequences will not be measured in basis points. They will be measured in purchasing power, in living standards, and in who ultimately controls the future of money. Flint West, signing off.